But Pankaj, you lived in India, you've been in India for a long, long time. You invested in early stage companies. What I'm trying to figure out, or I'm speaking to a lot of, when I go to India, and I'm going there for quite often, is a lot of these investors, early stage companies, who are taking a gigantic risk or losing or risking their capital, not even recovering their capital when they're investing into early stage company. Can you explain to our viewers what is angel tax and why isn't Indian tax code simplified for early stage companies?
Yeah, so it's a very complex problem. The Indian tax authorities have always looked at investments as a way for people to launder money. And I don't know when this happened or how it happened, but essentially they changed the tax code to prevent people from laundering money or bribes being given out. So like, for example, I'm a civil servant of some sort, you're running a business, and I come to you and I harass you for some money, and you say, look, I don't have the money to give you, but what I'll do is I'll give you a stake in my company. So when I pay dividends out, you'll get a dividend out of that. And you can deposit that right into your bank account because it's a dividend coming out of a company, right? And I'll say to you, okay, that's fine, but it's got to be at least this much, and you got to put it in my great granduncle's name, right? And so the Indian government saw that this was happening, and they put these laws into place that basically said, people are fudging their cap tables now and like adding people in and this and that, and they're either laundering money or they're paying off bribes to people that shouldn't be getting paid off. What's happened is those laws have stayed on the books, and the whole startup world has taken off. You are seeing startups raising professional money from professional investors, and they have been caught in that net now. So there are provisions that the government has put in place that says if you raise under 100 million rupees, so 100 million rupees is approximately, if I remember correctly, a little over $1.5 million, somewhere in around that range. If you raise a total of less than 100 million rupees, you are exempt from paying this tax.
Okay.
Now the tax is it's calculated by the internal, whatever their revenue service is called, Department of Revenue or whatever it is. They and their officers are responsible for meeting these companies and assessing what is your company worth. So they will do essentially a discounted cash flow analysis on your books, and they'll come up with a fair market valuation for your company.
And what is fair market?
Well, fair market depends on your cash flows, right? And so it
doesn't take IP, trademarks, anything into consideration?
No, IP, trademarks, market goodwill, anything like that. Future potential for a market. It doesn't take anything else into account. It only takes into account your discounted cash flows. So, and most startups don't have any cash flows, right? Or very little cash flow. So what the tax authorities and Ministry of Corporate Affairs and some of these folks have done is they've gone out and they've gone to a lot of these startups. Many of them are now defunct. And they've gone to these startups and the founders and said, you know what? By our calculations and by the balance sheets and income statements that you've submitted to us, the worth of your company should be X. You raise money at X plus 10, so now you owe us tax on that plus 10. And that tax is considerable. It's a little over 30%. Ooh.
So where you have in the U.S. states encouraging companies to start companies, build businesses, hire more people, create job opportunities. I believe I would take this as like a discouraging. Don't invest into startups or start a business.
Absolutely. And I don't remember exactly when it was, but I think it was 2012, 2013. A bunch of us, we created a huge stink, about the fact that companies that we're investing in are being forced to pay tax on the money that we've given them to continue running their business operations, scaling, growing, creating jobs, creating some IP, and this is in India's interest, right? To have intellectual property developed over there, to have an environment where people are taking risks and promoting entrepreneurship, creating jobs. So eventually they put some of these other rules into place, like below that 100 million rupee mark. Over the last couple of days, there have been a lot of tweets going around, myself included, about this. So the Department for Industrial Policy and Promotion, DIPP, tweeted back out that they're responsible for solving it. And they say that there's a provision in the tax code that's been in place since April that allows startups and angel investors to claim an exemption. Now, I don't know the details around this, but if there's still a limit, right, that's great. It's helpful for companies that are just starting out. But $1.5 million fundraise today is not a whole lot. Many really interesting seed companies are raising $1 million in their seed round. Series A's are generally more than $1.5 million in India. And so, but a Series A company is still a very high-risk company. There's still a lot of things to figure out. Many of them don't even have product-market fit yet. They have the potential to grow into something huge, but many of them wind up failing.
But we just saw in Blipper, who raised
$37
million.
Exactly.
Series A, B, C, you don't know
exactly.
in the age of technology when you're going to become
exactly.
obsolete.
So now what you're doing is you're discouraging investors that are coming in at the Series A, B, C, D, E, J, whatever that is, from continuing to write checks. Because, look, the truth is that technology startups don't have a valuation method that's based on a DCF. It's just not, right? You're betting on the future. You're betting on the fact that you are going to create a business that is going to disrupt something. You're going to fundamentally change the way things happen. And hence, we're going to give you a valuation that supports that. And also, you don't want to over-dilute an entrepreneur too early, right? The entrepreneurs still need to be incentivized to stay in the business and continue the business for a long period of time. And that period is at least 7 to 10 years. So, a lot of these things put together are sending mixed messages. And a lot of startups are incorporating overseas. They're incorporating in Singapore, Malta, Estonia, the US, of course, and other places, because they see this as a way of protecting themselves against things like the angel tax. Even if they're focusing on the Indian market, they're incorporated overseas.
So this is funny you bring it up. I invested into a company with full disclosure. I invested into a company called VideoTap, which is into the video platform, building that infrastructure. And they actually did relocate from India to Singapore. So I know what you're trying to say.
Yeah.
So I hope the Indian government does take this and try to solve this and make it easier for more investors to invest in early stage companies, which will help entrepreneurs to build great businesses.
Yeah, I agree.
With that,